Let's start first with the warnings. 70 to 80% of people lose money at trading according to the regulator and according to any of the brokerage sites which are by law required to put that up there. So that's the first warning. Second thing is you should never trade if you think you're going to get rich quick or it's with anything other than risk capital, because the chances are you will lose it all. So for most of you, at least 80% of you, walk away now. Go away, turn off, switch off, whatever. But I wanted to just give you an educational example of what it is that traders actually do. Well, the profitable ones at least. Now, this is a common retail platform. The data on there is live, real-time, free that you see. It's called MT4. Many brokers offer it, so it's broker independent, not trying to plug any particular broker. If you're a beginner, you might have a fixed stop loss. I'd suggest you do it at the point B and a fixed take profit at point C or a limit order. Why would you want to do that? Because it's a bit easier. You're a beginner. You still need to know when to enter, which is at that point A. And notice how we didn't pick the bottoms. We were following a trend first. After a lag, we got into that. It's a whole separate discussion there. Any losing trade should be, like at point D, should be small in size, short in duration by the nature of the strategy. If you don't have a strategy which gives you small losses which are short in duration, then you haven't got a strategy. An intermediate trader may well just have a trailing stop, which is stepped, not trailing dynamic, doesn't move point for point, but stepped. Why? Well, by the time the price goes from A to C, only then would your stop loss move from B to A. It gives your position a bit more time to move, a bit more space to move up and down before the stop loss might otherwise have got whipsawed, hit, and then the price moved in your original direction in any event. If you're an advanced trader, you'll probably have that trailing step stop loss, and you'll add to winners at the point C. Point C is equidistant from point A to B. That's the same distance from A to C, and that'll have its own stop loss at point A. Now, two other things you've got to remember. Winners add to winners, losers add to losers. So don't add to your losing positions. That's why you're only adding to your winning positions. It allows you to start small, knowing that you're going to add to a winning position later. Where do you find your stop loss? Well, you might do it by experience. You might do it through just by eye, or you might say, well, it's volatility-based stop loss. Therefore, the more volatile the market, further away the stop loss, and further away the stop loss, smaller the position size, so you don't lose more money if the market's more volatile and the stop loss is further away. You might need to listen to that one again. Okay, that's an important characteristic of successful hedge funds and making money. It allows you to start small and means you don't risk more money if the market's more volatile. It also means each stop loss is specific to that particular trade and the instrument and the time frame you might be trading. Okay, more links in the blog if you actually want to learn and be educated about what hedge funds do.